All right, so I wanted to jump into just a few different strategies when it comes to investing that have proven to be smart performers over the last year or 100 years or so. All right, hello everyone. Welcome back to the Investors Podcast.
Nailed it. There we go. Nailed it.
We've had a lot going on recently here in Melbourne, haven't we?
Oh, God. Earthquake.
Earthquake, riots. It's felt a little bit unsafe. It's been weird.
You know, it's funny, right? Like, you know, for many years, like, you kind of always thought, oh, like, Melbourne, that, you know, what do we get voted best place to live in the world?
Most livable city
Most
in the
livable
world.
city for, like, 10 years in a row.
Yeah.
And
I reckon we'd be out of the top 50.
mate, we're probably the worst place to live in the world right now, literally.
Yeah, I don't know about that. There's
Yeah,
not
no,
much.
You're right.
Come on.
I know that. But it's, you know, it's interesting, right? Because it just shows how quickly things can change, and especially like how, I think more so how dependent you are on external, or kind of how some external forces can play such a pivotal role. Like, you know, we talk a lot about politics here, or Andy does anyway. So Andy's always fucking talking politics, and it's interesting because it's like, you know, as much as like, because Andy always gets into me because I don't pay too much attention to it. We had a bit of an argument last week, but the whole, I do agree that these external forces do play such a role, because you've got different leaders in and people running the state and so on, and you know, where it's like you start to think potentially what could have been different if maybe someone different was in charge. And I'm not saying like,
I reckon it'd be just minor. I don't think it would be that full on.
Yeah.
Do you reckon it'd be that much different if we had a different government in the last 48 months?
Yep.
You reckon?
Yep. I think we're seeing in Sydney the difference.
Yeah, but they've gone through hell the last couple of months as well.
Yeah, but I don't know, and maybe I'm wrong, but I feel like she's handling the situation better.
Yeah, I suppose we've gone about it
like
by just enforcing.
We got no fucking idea what the fuck's going on.
Yeah.
None.
Sure.
At least she's direct,
Mm-hmm.
you know, and she's kind of created a clear roadmap. Ours changes every fucking 20 minutes.
Are they the same government?
No.
Nah.
She's liberal.
Oh, she's liberal. Oh, here we go. Argument for liberals.
Anyway, I don't know. I think it's a tough situation for anyone to actually be in.
Melbourne's, it's felt like a pretty scary city recently, hasn't it?
Yeah, the riots.
Considering we're used to just everything being nice and easy here.
I got a message. We got a message last week. Me and Liv were here, lucky, because they were lit like
they walked past your house.
Yeah, when they were
really?
going through Kingsway.
Wow.
So, you know, we got a message saying, don't, you know, if you're outside, make sure you go inside and stuff. So, you know, I guess this is perspective in a way, right? For like, there's countries that this is the everyday life, you know, that I've never experienced.
Yeah.
So for me, it's kind of like, I put it into perspective. That grounds me a little bit. It kind of just keeps me going.
But then we're back to normal this week. Like, it just feels like a normal week. We've got sunshine again. It's starting to feel
Are they
warm.
still protesting?
I don't think so. Maybe there's probably your diehard guys who are out there still.
Yeah, I don't know.
But they've probably partied out from the weekend.
Oh, yeah, grand final would have got them.
Yeah.
All right, so what are we talking about today? So this is an investors podcast, by the way, guys. That's why Brayden come in with his magnificent intro. That is, you know, it's 1% improvement every week, I reckon. That's what we're aiming for.
That's it. We're going to compound that.
Also, what we're looking for is Andy not to be a shy mess on the show. That's also what we're looking for. Andy's, you know, be quiet. You know, if you know, we want the real Andy to come out.
I just don't want us getting into fisticuffs every week. We'll keep that one off camera.
It's not a face for this though, is it? Not with that haircut, mate.
Oh, well, I'll make sure that I'll cut your face out of the rest of this clip then, so that's fine.
All right, so what are we talking about today?
All right, so I wanted to jump into just a few different strategies when it comes to investing that have proven to be smart performers over the last year or 100 years or so, just so that people are aware of all the different strategies out there. And because it doesn't have to be specific to one, it can be beneficial to have a broad range of different investment strategies going on at the same time in order to try and get superior returns.
This is something I'm really interested in because, me personally, me and Liv are kind of really looking at the moment to obviously purchase property, and we're kind of going through this weird dynamic where we're diversifying what we're doing. So it's definitely something I'm going to have my ears open to, and I think everyone else as well, because you often get caught up only focusing potentially on one. Like a lot of people come up and they focus heavily on property.
Well, it's hard to master all different investment strategies all at the same time, because it's such a steep learning curve. Whereas, the guys who actually do really well have quite a diversified investment portfolio.
Yeah, 100%. And that's kind of one thing that we're thinking through at the moment is like, okay, well, because I think the biggest thing as well is that understanding there's different consequences as well for each. It's not just about whether or not it's a good investment. It's
That's
like,
right.
Property, if you're, you have to put a large chunk of money down. Does that restrict your your lifestyle? Does that put pressure on the relationship that you have with someone? Maybe like these are all questions that me and Liv are working through right now and kind of trying to find out what the right dynamic is for us. And when we even when we look at something like property, it's like, well, what's the right move? Because it's not just about investing in property. There's many different scenarios that can play out. Do we live in the first home? Do we get an investment? What suburb are we buying in? And so on, and what lifestyle impacts do we have? And that's one thing that we went through with PJ when we talked about property was like, not buying for the sake of buying, but also understanding what you want out of the investment as well. So it's definitely something, this is a great topic for a lot of people.
And it's hard because it depends on the business cycle that we're in as well, and it kind of feels like we're at the peak at the moment. And so everything is really expensive. And so you need to also factor that in as well, because...
So when you say business cycle, so because I understand what you're saying, but for the listeners, what are you talking about?
So typically it goes off of credit and GDP growth. And so we're at a point now where we've reached basically a point where everything is funded off of credit. And that can be a somewhat tumultuous period because there's going to have to be some sort of correction at some point. And so, we're sort of waiting for that. And we're waiting for one that typically hasn't happened for, it's been nearly, 70, 80 years since the last proper economic downturn. So we're sort of waiting for that to happen. And typically when that happens, as we've discussed in the past, there's a period where the dollar could devalue, or there could be some sort of instability within all the markets and that sort of thing. So,
are you usually looking for like one? Is there usually a kind of an event that usually tips these things to actually start to happen? So it's like almost like they call it a bubble, right? And something comes in and pops that bubble, and then that's what causes the psychology of just get your money out of the markets, do all these kind of things. So we've got a mix of all different concerns going on at the moment. So you've obviously got all the issues that are coming out of China with their economy slowing down and the issues within their property market. We've also got the Fed talking about tapering. And once they start tapering, they'll start to look at interest rates. If they increase interest rates typically within a year, that's when you'll see a pretty significant downturn. So tapering is obviously they're putting money into the economy and they're going to start to pull back on that money. Yeah, they'll start reining in how much government debt they're buying every month. And then they're going to, once they do that, they'll sort of have a feel of how the economy is performing without all this stimulus. And once they think that it's right, they'll start to consider increasing the interest rates. And once they do that, growth typically then slows down, which is why markets tend to suffer. Yeah, and what we're looking at then is once interest rates go up, once the tapering comes off, that's when, if you we've got to look at jobless rates. We've got to look at these kind of things. Because right now, there's a lot of people that don't have jobs, but they're getting funded by the government as well.
Mm-hmm.
You know, so there's still money being pumped into the economy, people getting paid for nothing. So, you know, I think from what I read out of this is you've got to look at what happens once that tapering starts to happen. How does people's decision making start to change? How do the markets start to change? And then, you know,
and everyone's mixed on this too. Like, you've got all the macro guys who are focused in and saying that we're going to go through a deflationary period. You've got all the economists coming out saying that this is everything that's happening is going to be bad for inflation. So we don't really know quite what's going to happen. It's just a matter of waiting and sort of seeing what's going to pan out. But it's like, this is an important time to get your money and your investments in order so that you can either ride it out or perform really well.
Definitely.
It's a lot to think about.
Well, so when you say ride it out, you're talking
a potential downturn. There could be
getting your ducks in order.
Yeah.
You know, so making sure you've got the money there to pay to live on, and you know, you still got
you got to make sure you've got all your expenses covered, and then try to minimize the damage to a portfolio if there is an event where the markets crash, and that can be in the property market and also the equity market, because they're both quite overheated in all areas around the world right now.
Interesting. Very interesting. All right, so we're going to go through 7 strategies?
Six
strategies.
Different strategies,
cool.
Yeah.
What are we starting with?
So the first one is investing into a bunch of ETFs. So benchmarks that track different assets within the economy. But overall, broadly, we just want ones that track the overall benchmark. And the best things about this is that it's diversified. You don't have to do a lot of the work yourself. You just have to figure out which ones are going to be the best ones for you. But that's the key to any portfolio. And a lot of superannuation or Roth IRAs and this sort of thing are invested in these diversified portfolio, because over the long course they tend to outperform due to compounding and that sort of thing, and that's what we all retire on. So they make the foundation of any portfolio, and that should be the same with your investment portfolio, because let's be honest, we're not all Warren Buffett. We're not all going to outperform the market by 17% a year or whatever.
We think, you know, and that's one of the things, like, you know, that you can kind of get caught in the trap of thinking that you are, you know, like I kind of think I'm okay at it, and I've been doing it for 2 years, so I'm probably horrible, you know, and you can kind of get caught in that trap.
Well, that's the thing, yeah. Anyone can do well in a bull market. Yeah. It's whether you can stand the test of time and actually outperform in the long run and go through multiple downturns and recessions as well.
100%. And that's where these ETFs come into play, because they do the work for you, as you said.
That's right. They're easy, they're tax efficient, they're low cost. And so in that regard, they're really beneficial.
Yeah, and we kind of talked about this, I'm pretty sure, in maybe episode 1 or 2, where we're talking about active versus passive investing.
Yeah.
And I think more importantly, an ETF is a strategy for someone who makes one of the decisions to, you know, or the decision to be more passive, right? Where it's like, I don't really necessarily want to spend, you know, hours doing this research.
Yeah.
But I'm going to do enough research to be able to identify which one I think is going to, you know, help me achieve my goal.
Yeah, exactly. The only issue with them is that they don't tend to grow obviously quicker than other asset classes, but that's because they have a mix of different assets within them. So they typically will hold on to a certain amount of bonds, equities, real estate, these sort of things. But especially right now, things like gold and commodities, they may not be outperforming. And same with bonds. Bonds are actually negatively returning yields at the moment. Whereas then obviously you've got your equities and your property, which is outperforming. But you're not going to get the same sort of return that you would if you had directly invested in property or equities. And so that's something to factor into. But typically when you're buying an ETF, you're buying it for the long term, knowing that it might double your money every 10 years or something like that.
And there's less risk involved, right? So
less risk, yeah.
So in times like now, it's like you invest in an ETF because it might not be going up at the, you know, maybe the 20 to 50% that you might get out of a stock or an equity. But in reality, it's not going to go down to the 20 to 50%
No.
that you could get with a stock or an
Exactly.
equity.
It's going to
too.
go down less than what you would if you own just individual stocks,
Yeah.
but then it's also probably going to recover slower as well, whereas stocks will recover a lot quicker.
For sure. So, what are some examples then?
Some examples of different ETFs.
Yeah.
So you got your Vanguards, you got your Beta shares, you've got Kathy Woods and her ARC products.
Go.
There's Goldman Sachs, all of them as well. So there's all sorts of different ones. It's just a matter of determining what area you want to invest in. So you could be looking at investing in the US market, the Australian market, the European market, emerging markets, and this sort of thing. You may want to invest in just the S&P 500. You may want to invest in small cap companies, high growth companies, dividend paying companies. So it really depends on your risk appetite.
Yeah, and so
this is where you do have to do a little bit of research.
cool. And something like the S&P is very low risk.
Yeah.
You know that you're going to get your 10% a year or roughly around that.
Yeah, you're going to receive dividends from that because often the companies are really cash flow positive as well, and they tend to reward their shareholders. But then towards the bottom end of the S&P 500, it factors in a lot more growth, and so that's how you can outperform from your capital appreciation, but then also having dividend plays in there as well.
And then you've got something on the other end of the spectrum, like ARK Invest at the moment, which is directly investing in innovation and, probably a little bit more risky. They can sometimes have negative 3% days and so on, which you don't really see in the S&P. But you also, I think, in 2020 they had like 70% returns, and they've had an average of like 25 or something like that over the last 4 years or something. So you're definitely getting a greater reward. So, but it's also when you're investing with them, you're probably someone who's quite innovative yourself.
Yeah, and typically when you're looking at an investment in ARK as well, a lot of the decision making around their decisions is influenced by new and emerging technologies, and these can be volatile, but then they can also be subject to regulation and decisions based on risk and these sort of things, because when there's times when the Fed are looking to increase interest rates, typically these growth companies will do worse because they can get better returns in less risky assets. And so that's something to factor in as well. So the fact that we're now talking about increasing rates could mean that there'll be a period where these companies don't outperform. So that's something to factor into as well.
Very interesting. Very interesting. So you're kind of changing your strategy based on the environment.
Yeah, so typically whenever I look at an investment strategy or the economy as a whole, I will look at all the macro data first and where we are in the business cycle, and that will basically determine how heavily invested I am in a certain asset. So right now, because we're sort of coming towards the end of the business cycle where everything is really quite expensive, I still own equities, but I'm starting to diversify away from that into these other sort of fields. So it could be things like gold, it could be things like cryptocurrencies, these assets that aren't correlated with property and equity, because when they typically don't perform, these other ones do. And so it's handy to have a bit of a mix in your portfolio, just so that you can do well in times when the market isn't so hot.
I think the business cycle thing is so interesting because, something that we try to teach in the first part of one of our courses is understanding economic cycles, because I think it's got some pretty heavy business applications as well. Everyone can make money in a booming economy, but it's it's such an interesting stat. Everybody knows that 1 in 10 businesses doesn't make it. Sorry, 1 in 10 businesses makes it past the 10-year mark.
Yeah.
And it's so the correlation is, every 10 years we go through a recession, or roughly. So it's kind of how much does that factor into that stat? And I would say quite a bit. So I think understanding your business cycles, whether you're a business owner, whether you want to build wealth, or, they both go hand in hand as well, is when you can start to look at business cycles and make decisions based on those business cycles, you can probably be one of those 1 in 10 people, right? And that's what your goal should be. You know, if you're watching this podcast, don't beat around the bush here. You're here to build wealth. You're here to build a business and take your idea from 0 to 1. So, you know, business cycles is something that you have to start to understand in order to be able to make correct decisions.
Yeah. Well, while we're on the topic, so one of the strategies that I've got in here is actually entrepreneurship. So it's actually starting your own business. Because you typically learn so much, and it's a great way for you to build an income outside of, say, your job or your other investments. The only thing with that is it is really time dependent. It costs a lot potentially as well, but the returns, the potential for returns greatly outweigh everything else you can possibly do. And so starting your own business is one of the best methods to outperform the markets.
Yeah, it's definitely the best wealth building tool out there.
Yeah,
like
100%.
Investing your money is really important, and I think it's a necessity. And one thing I'm learning definitely, but I think if you can get a business and kind of have a really successful business, you know, like that will generate more income than anything.
Even just the skills that you'll learn from starting a business as well, they can be applied in so many different fields. So even if that business doesn't do well, you can then carry those skills into potentially another business, or when you're going back out into the job market as well. And so, yes, there's the chance of really high returns, but then obviously there's the risk that it doesn't work out. But you have to weigh up the pros and cons, and in my opinion, the pros far outweigh the cons.
And I think with risk as well, right? Like, you know, once you get into owning your own business, you know, it almost crosses over, right? So when you're starting your own business, you're already taking a risk to start your own business. But what you do is, like you said, is you build skills and you learn that you have to take risks in order to actually get forward. Now, calculated risks, they need to be. But I think the biggest thing is, like, you know, I'm willing to put 80% of my money in the markets or into investments because I know that if it all went to zero tomorrow, I would still be able to use my skills to generate income and get back to that point of where I was. Yeah, it might take me some time, but I'm confident in my ability to do that. And I think that's one of the most important things in life in general.
I also think when you start a business too, you're learning those skills when it comes to sales. You're learning also financial literacy, which makes you a better investor because you know what to see just based on your own business too. And so you know what works for your balance sheet and your income statement and that sort of thing. You can just find the same replication in other businesses and know that they're performing well. And so you can make an informed decision based on your current learning within your own business too. And so that's a great strategy. Honestly, I think it's one of the best strategies you can take. Obviously, it's not for everyone, but if you are entrepreneurial minded,
but it's interesting, right? Like, you know, like we've had this conversation and it's like, well, based on the fact that, you know, wages aren't growing, but the cost of living is, and you kind of look at that as a dynamic, you know, what's the consequence there? Well, it's not going to make economic sense for a lot of people to have a job.
Yeah.
You know, it's just not. So you know, the stats are saying, we've done a lot of research on this, that, you know, by the time, I think it's 2028, 70% of people in the world could be self-employed.
Yeah.
Right?
It's crazy, isn't it?
Yeah. And it's, you know, you just think that's a behavioral psychology thing, right? It's like, you know, you look at the stats, you look at the way the world's trending, and it's just, you know, is $100,000 going to buy you much? No. Right? And it's not, you know, like, and that's mate, to be honest, that's like that's a good wage, you know, that's $100,000. Like, you know, some people don't earn that much, right? And it's like, if that can't buy you anything, what's it going to look like in 10 years' time?
Yeah.
And I think, you know, honestly, like, entrepreneurship it's such a journey, you know, like, it's just, you learn so much about yourself. Like, I think about how far I've come, you know, I'm 10 years out of school today, and I'm like, fuck.
crazy.
Crazy. But I would not be the person I am without business.
Yeah.
Because business doesn't lie. Business doesn't beat around the bush. Business kicks you in the teeth when you need it. And it teaches you so many lessons.
You've never worked, apart from when you were really young, but you've never worked for somebody else, have you?
I've had so I think I had a job for a year.
Okay.
So I didn't have a job up until I was 18 because I was playing football and trying to make a career out of football. And I was very lucky that my parents said go for that. But I was also a lost puppy when I come out of that. So I had a job for a year and I think I got fired from one. And I'd probably get fired now because I'm someone who likes to run on my own clock. Do you know what I mean? But it was kind of like, I had a job for a year and I had a few different jobs, and then I got straight into running my own business.
Yeah.
And probably didn't know I had a business until 2 years in. I just fucking didn't understand what was going on.
Yeah.
I think it was my first accountant trip, 2 years in. Hadn't paid taxes, hadn't done any of that shit. And then,
but these are the skills that you've now learned.
Exactly, right?
Yeah.
And that's what I mean is I just think about how much business has molded the person I am today.
Yeah.
It's taught me so many lessons, and I'm just extremely grateful.
And there's something to being able to generate money off your own bat as well, as opposed to just going in and getting a salary. But for those who do have a salary, I think there's so much to be learnt from just going out there and starting something part-time too, whether it be a little freelancing business or an online store or wherever it might be. I think there's so much benefit to doing that. And typically businesses will do well in no matter what cycle we are in as well. So during a downturn, obviously there's something that's gone wrong, and so there's plenty of problems in the world that need to be fixed. During times when things are doing really well, obviously everything's doing well, so you can do well in any environment.
Yeah.
But it's just one of those ones, it's just rock hard. You won't be able to, or you'll be able to win if you give it a crack and you just continue on the course.
Yeah, 100%. I think it's, something I wish that everybody, even if it's just a side hustle, you get into at some point and you just take the leap and kind of let it go. One of Liv's friends is just recently started a business and she works full-time as an accountant, and they do gifts. So I think it's called For Her Gifts. Little shout out, check them out on Instagram. But, they're doing that and but both of the owners work full-time, so they're doing outside of hours. They had a pop-up store in Chadstone and so on, and they've had some success with it. But it's interesting. I don't know what their plans are for the future, but I just think about them and I think about what they must have gone through over the last year and how much they would have learned, and it's just it's awesome. So I think everybody needs to go out there and try something and make sure it's something that you're passionate about as well.
But even that extra 10, 20, 30, 40,000 or however much it is on top of your salary as well can make such a difference. If you're living paycheck to paycheck and then you have this additional money coming in, that can be the thing that helps you put towards savings to help actually grow your wealth.
100%.
I think that's the real game changer for people. If you're out there and you're struggling, find yourself a little side hustle that will just give you that edge to get you forward and moving ahead in life.
Yeah, definitely, 100%. It's one of those things that I think is so important, when it comes to savings. Like you said, that extra 30 to 40K, that's really all you need. Because once that starts compounding, all of a sudden you find yourself with a buffer.
Yeah.
You
2
know
or
what
3
I mean?
years' time, that could be potentially a house deposit.
You put 20K in the market.
Yeah.
It can be life changing.
Yeah.
It's like you just never have freedom like you've ever had before.
Yeah.
All right. So next strategy.
All right. The next one, we're talking about dividend growth investing, and so
this is an interesting one because this is like the this is what I get.
You associate this with people who are older. Yeah.
It's like, fuck your 15% a year.
Which is crazy to think about, but we have to remind ourselves that the current market that we're in right now, we don't typically see that every year. 15% on a good year is a bloody good return. And so if you find that return in a diversified dividend portfolio, it can be so beneficial to you, and it's a passive income that you can be receiving. So we're talking about that extra 30, 40,000. You can get that additional income from these companies. And so the trick to finding these companies, though, is you have to find companies that have a large moat and have really, really good financials as well. So I'm talking about, I mean, I hate to say it, but banks. Banks have a really large moat because they're really hard to get into. There's a lot of regulation around it. I know from personal experience, it's very, very difficult to get into the banking sector. But then you're also talking about consumer staples, so your big supermarket chains, and then also your smaller retail products, so like Coca-Cola, these sort of brands that just generate so much cash, and they typically reward their shareholders as well. But then the best way to then take advantage of this is to broaden the markets that you're into. So you don't want to just be purely in the banking sector, or you don't purely want to be in the consumer staples or energy or anything like that, because there's all these different macro stimulants that can have adverse effects on these markets. So if you have a good diversified portfolio of companies that are producing income, it can make such a difference.
So what is like, when we're talking about going from, what is a dividend stock, right? So for someone who's listening who kind of goes, I don't know what really you're talking about. So what is a dividend stock, and obviously the benefits of cash flow, but do you want to talk a little bit about that?
Yeah, so a dividend paying company is a company that has so much money sitting on their balance sheet in retained earnings that they have grown so large that they don't know what else to spend the money on. So typically with growth companies, they spend that extra money on innovation, on marketing, on R&D and these sort of things. But a big company like Coca-Cola, there's only so much that they can spend their money on in trying to produce a new asset or acquire a new business or something like that. And so typically once they reach that point, they start to reward their shareholders for having faith in them throughout the growth years, and they start to pay out that money that's just sitting on the balance sheet, and they do that in the form of a dividend. And typically dividends have had taxes paid on them first by the company, and so they can be really tax advantage for a investor because they're fully franked dividends. And so they can become basically almost a tax-free passive income that you can receive on top of your salary or whatever the case may be.
Yeah.
And so this is typically what your retirees will live on from their superannuation or their social security or whatever the case may be. They'll live off those dividend payments.
Yeah.
As a form of income.
My partner's dad's been doing it for years, and,
Yeah.
and he's kind of, he's definitely
Invested in BHP.
Yeah, well, I was invested in BHP for a little bit, and it was, they're actually, they actually had seen some growth during those times as well. So I think if you can find, it's very hard, but if you can find someone that's going to pay you a dividend and, they have some growth in them.
They're not going to grow a lot, but they're going to grow at potentially single digits, maybe even double digits. Iron ore has been doing very well the last 2 years, and so obviously BHP and Rio and these sort of companies have outperformed over the last couple of years while still paying a dividend, which is pretty unreal. And so that is an excellent strategy in order to beat the market.
This is another way to create a passive income, right?
Yeah.
Like if you can get if you can get $1,000 a month in passive income, and then potentially just reinvest that $1,000 back into the markets, and they even have the dividend reinvestment programs as well, where your dividend just gets reinvested into the shares, and so your dividends end up growing time after time. So the whole idea is if you can if that's the way you want to go, you want to generate more cash, more money coming to you, then that's probably your investment strategy.
Exactly. And guys like Warren Buffett, they live and breathe dividends, I don't remember how much he received. It was $600 million or something just from his Coca-Cola shares, whilst these shares have been compounding over time, and he just reinvests that money, and you can do the same thing within your own portfolio if you have a diversified dividend portfolio.
Crazy.
Mm.
Crazy.
I know it's not something that we typically look at when you're young because it becomes more about growth and that sort of thing. But once you start to reach a point where you have got a significant amount of money sitting in your portfolio, in order to have that additional income, it can be such a rewarding investment to make.
100%.
Definitely,
And
they typically do well during times of a downturn as well, because they will
resilient.
You'll find that a lot of these companies continue to pay out those dividends, especially if you look at individual companies as opposed to ETFs, because they have different mandates when it comes to paying out dividends too.
100%.
Yeah.
Next strategy?
All right, so the next strategy, this is a pretty advanced one, so we might want to skim across it, but it is selling and buying options within the market. So you can get quite a lot of income from doing so. So when I say buying and selling options, these are derivatives. A lot of people think of derivatives as being really risky, but an example I like to give is that you can actually buy a put option. If you think that a company is going to go down in price, you want to buy a company cheaper, you can buy a put option right now, get paid a premium up front because someone else is on the other end of that option. So they will buy that option, they will pay you a premium up front, so essentially a dividend. And then if the price comes down, you get to buy in at that price. And so you bet to buy on the dip whilst having received an income initially as well. And then there's this, you can also buy covered calls too. So if you think that the market is going up like we currently are, you can buy a covered call on, say, CommBank, for example, here in Australia. You can buy the covered call on them. You receive your premium up front.
So when you say premium, what do you mean?
So it's essentially, so someone on the other end of that contract is paying a price because they want the opposite to happen. So that example, they want CommBank shares to go down in price. And so in that regard, they're happy to pay you a premium in order to have the obligation for you to sell them those shares in the future if it goes down in price. If it doesn't go down in price, you get to hold on to those shares, but you also receive that income straight off the bat as well. And so it's a really, really good strategy to just generate an income, especially in a market that is going sideways or up, which it typically does do. And so I've been doing it for years. It's such an easy strategy if you actually put in the work and learn how to actually enable it. But it's one of those things you can just repeat every single month and get a decent amount of money up front based on.
What are the negatives to it then? Like, because there's obviously like when there's smoke, there's fire.
Yeah.
Right. So what's the negative side to it?
So it's a long-term strategy. So you need to be mindful that you are buying into it and waiting for it to eventually come out. And if it does go against you, you then have the obligation to sell. And so in that regard, you will lose out. You'll lose money. So you'll get to keep your initial premium, which is great. And typically, if you pair it with a stop loss, you may only lose out a little bit. But there is the potential for you to lose out if there is a wild swing in the market.
Is this kind of aligned with what's been happening with like GameStop and these kind of things?
Yes, it is. So a lot of the institutionals have been on the wrong side of this because they have been selling puts against GameStops because they think that it's going to go down in price. Once it goes up, they've been getting the margin call, which has been forcing them to either pay the margin from whoever has lent them those shares, or they have had to buy in at the market price, and if there's no shares outstanding, expensive. It sends the price of those shares high. And so that's what's happened.
So so basically these big institutions are either forced to pay the margin or they have to buy in at that higher price, costing them money.
Exactly right. And typically, when there's only so many shares available at the time, them trying to put in enough offers and bids in order to buy those shares is what has sent the price extremely high. And so that is a very risky way of doing things. So I wouldn't necessarily recommend shorting, but it can be a great way to receive income. And I wouldn't do it on a speculative company like that. You might want to do it on, say, like a BHP or a Commonwealth Bank or someone like this. This is their share price is a little bit more consistent. You're not going to see wild swings, but it can be a really, really generous way to make money as well.
But that's more of an advanced strategy, isn't it?
Yeah, I'd say it's more of an advanced one, for sure.
Cool.
Yeah.
Awesome.
Next one is real estate. We've already touched on this, but there are so many benefits to it, especially in the current interest rate market where you can go out and get an 80-90% loan against the property. Yeah, there's cheap capital essentially. So you only have to put down, first getting your deposit is the tricky part, but the advantage to it is that you can get the majority of that on credit, and that allows you to get into the marketing and start to build equity. And if you're buying a rental property as well, you receive rental income on that property too. And so that's another great way to beat the market as well. Because typically, especially now, you're seeing houses appreciate in value quite a lot.
Crazy.
Which you've had first-hand experience, as you know.
Yeah.
But then also there's that additional income that you can receive too, which probably will start to rise as well. And we've started to see rental incomes increasing all around the world, just not quite here yet in Australia with lockdowns and everything going on, but that'll be the next thing that we'll see is those rental incomes will start to increase.
I think that's one of the you look at why property is such a great wealth building tool.
Yeah.
You've got the ability for it to appreciate in price, which obviously allows you to build up equity. It's also forced savings, right? So, rather than paying rent or even if it's an investment property, someone else paying that mortgage down, it's kind of like forced savings. So I guess that's why a lot of people, when they think about, I don't really want to think about my investments too much. Mm-hmm. Property is one of the first things they think about because, I think without understanding completely, we understand that it does kind of force savings more than anything. And if the property goes up, the property goes up. But more than anything, it's like a way for people to build wealth. And I mean, this is probably more down the line of the barefoot investor, right? Which we don't necessarily agree with, but he kind of thing is, if you pay your property down, you're just basically building equity, and that's something that you can enjoy a little bit later on in life once you're retired. And
it's tax advantage too, so you can have write-offs if you're negatively geared. But then there's obviously there's the drawbacks to it as well. So you have to obviously do the research, and it can be really quite time enhanced if you have to go out and find the right areas that you want to buy a property in. Putting down a deposit, obviously that can be quite a lot because, especially now with property going up so much, you're putting down a lot of money obviously as well, and then you're obviously fixed into that repayment over the course too. But I mean, there's benefits towards doing that too. But then you've got all the fees, taxes that come with it. So you have to be on the ball when it comes to property, and you have maintenance as well.
If it's an investment property, you've also got the potential of having, some not so great tenants in and so
that's
on.
it. And you've got to factor in there's going to be potentially times when you don't have any tenants in there too. So you have to be able to afford those mortgage repayments during those lean times. So these are all different decisions that you've got to factor in. But I mean, a lot of big dynasties have been built off property, and so it's a great way, obviously, to build your wealth and to beat the market as well.
For sure.
All right, so just quickly to wrap up, we've also got one more, which is alternative assets. So things like commodities, gold, silver. Now, these assets don't typically perform well when the market is running hot, as we've seen with gold. Peter Schiff is quite angry with himself over the last couple of years, but they typically do well when there's some uncertainty in the market, because it's basically a store of value and a safe haven, if you will. So they typically perform in those sort of periods. I would probably class cryptocurrency in that one as well, because these assets are typically uncorrelated to what's going on with the business cycle. So when shares and when property is outperforming, typically these don't do that well. But then when there's uncertainty and doubt and markets are correcting and that sort of thing, these do outperform. And so it is handy to have them in your portfolio just to have a little bit more diversification. But then you've got your cryptos, which are uncorrelated to all of them and have been increasing at 110% a year. So another great place to obviously put your money. But then I would categorize in there as well just learning new skills too, because you can rely on those skills later in life. You can get out there, have a side hustle, get a new job, that sort of thing. So I would label that as an alternative investment too.
For sure. What's your one piece of advice then for someone who's listened to this episode and is kind of going, well, how do I figure out which one of these is the right for me?
Oh, shit. I would start with probably looking at an ETF to start off with. Get some money in there just so that you've got some skin in the game and you can start to see how different assets perform during different times of the business cycle. Pay attention to the news as well. I think that's a really key thing that most people should be doing. I know, currently it's all...
Yeah, what news are we talking about here?
Well, I'm not talking about COVID news. Or
you're not tuning into 60 Minutes tonight. That's fucking for sure.
But I mean, a great source of information is Yahoo Finance. It's maybe even Motley Fool, just so that you can have an understanding and get to sort of see how businesses are performing during different times, and try to get an understanding of the macro landscape too. So what's going on with interest rates? What is the Fed or the RBA talking about? These sort of things, because then once you start to see how these things are playing out, that then allows you to make certain decisions based off that in regards to your investments. But that's honestly the first way that I would probably look into it. Look into ETFs, look into property. Once you have those foundations in place, then start to diversify away from that. Start looking at individual companies. Start looking at potentially getting in on a gold ETF, or get a little bit of Bitcoin in your portfolio, or
explore your options.
And 100%, if you're not already doing it, start looking at starting your own business. Even if it's just a side hustle, something that you put 4 hours a week on. If you start to do that now, the benefits in the future could be massive.
So why does someone, and this is really important, but I want to get your point of view on this. What's the consequences of not listening to the information, right? Like what's the consequences of not investing, right? And not going and taking action right now? Like what are the long-term effects that someone might actually experience?
Yeah, so you're either just going to be getting by just comfortably, living not necessarily paycheck to paycheck. You'll be able to build enough wealth potentially to be able to retire on and live a somewhat normal and decent life. But you're always going to be worried about something potentially, like one bad event could cause you to be completely ruined, if that makes sense. So if you get a handle on these skills early and start to really make it a priority for yourself, it will allow you to have a little bit more freedom and action, able to spend time doing the things that you enjoy to do. You're not necessarily going to be worried about the market collapsing when you are worried about whether you're going to be able to keep your job and to keep a shelter over your family's head, And so this is why it's so important to have these skills and to be learning and just be curious about them. Yeah. That's the reason why I would focus on it.
Yeah, I really think it's a superpower. Like the consequences of not investing the money that you're earning, whether that's through a job or a business, means that you're sitting in cash, and we know what the consequence is there. Your cash is being devalued. Yeah. And I often think I'm very grateful, one, for meeting you and kind of getting my head into this space, but two, for just my now understanding that if I don't do these things, and I think about my life previously, that I was struggling paycheck to paycheck as a young person, 21, and then my business allowed me to start to earn that money. But even at that, you don't realize how much this can change your life. You don't realize that, you know, the money you're earning is being devalued, and that's what actually makes life tough. That's why struggle is continuous, no matter how hard you work, if you're not learning these skills. And I think that's probably something that I want everyone to understand, is that you can really start to make a difference in your life, in the people's around you, know, your family, your friends, the people that surround you, by taking these steps and taking this action, more than anything. So, you know, I think that's why we're doing this episode. That's why the Investors Podcast is here, is because, you know, if you can start to take some of the information that you're learning and just applying, you know, 1% every day, 1% every day, 1% every day, you actually, you start to see your life change. You'll start to see, you know, things get a little bit easier, if that's the right word. You know, you'll start to see your wealth start to compound, and you know, in 10 to 20 years time, it can be
People
can be the difference.
overcomplicate it too, and people look towards Wall Street, who they use their slang and they use words that we don't all quite understand, and they use all these derivatives that are so confusing. If you just dumb it down and just go back to the bare basics, often you'll find you outperform what they do, because they're living quarter to quarter. Whereas if you're playing the long-term game, that's typically where you outperform the markets. And if you prioritize it young, you can get the power of that compounding to work for you from an early age. And this is why you see guys in the news where, like, a janitor passes away with $8 million in the account. Like, all they do is they earn their minimum wage, but they put money into the market every single paycheck. And over time, like, you'll be surprised, that thing grows. Like, I know you don't look at your super very often. If you go in there and over time, you will have accumulated, obviously, quite a lot of money. And all you do there, and you don't even notice it, is because your employer is contributing towards that superannuation. Over time, once you get to retirement age, you'll have $1 million in there. Same thing can apply towards the income that you receive in your bank account today. You could have $1 million within this portfolio and $1 million in that one. That's just how it's that easy. If you just play to your strengths and develop an investment strategy that works for you, and just be consistent with it.
Yeah, consistency is everything, isn't it?
That's it. If you continually do it, you'll reap the benefits in the future.
For sure. All right, another great episode. I think what we're trying to do is tell a story here. We're trying to kind of teach you guys and educate you guys and give you a process and teach you fundamentals more than anything. Like, you know, the biggest thing here is we want you guys to be able to take action from this, and more so gain an understanding, because that's the way that you can actually make this successful for you. Especially when there's so much noise out there as well. I just think if you dumb it down to the basics, the bare basics actually can do well. For sure. All right, guys. As always, we really like. I got to say the support and the interaction from you guys over the last month has just been crazy. You know, on Instagram, TikTok, YouTube, all the support that we're getting, a lot of the interaction. We're extremely grateful. You know, we really care about what we're doing. We really do. Like, we really think that this is going to make an impact on all of your lives. So we're extremely grateful, and you know, we appreciate the support. Make sure that you're subscribed onto the YouTube channel. Make sure you subscribe to the audio podcast if that's how you like to listen, and keep interacting with us. Let us know what you want, what you want more of. You know, obviously across socials, but. Really hope you enjoyed this week's episode, guys, and we'll obviously see you next week.
Thanks, guys.